Welcome to our deep dive on home affordability. We will connect the popular $500,000 purchase target with practical cash requirements, safety buffers, and real-world monthly budgeting. As we move through the lesson, we will use clear rules of thumb, example scenarios, and diagrams to help you calculate your own number with confidence. First, we will outline the $500,000 dilemma and why it often appears for households earning around $200,000 per year. Next, we will highlight the importance of a separate emergency fund. Then, we will examine the cash needed at closing, including down payment and closing costs. After that, we will apply the 30% rule to avoid being house poor. Furthermore, we will evaluate controversial market entry strategies, such as using 10% down with PMI. Finally, we will walk through a step-by-step method to calculate your own affordability and test your understanding with short quizzes. Before we begin, please note this is general education. It is not financial, tax, or legal advice. Your circumstances are unique, so consult qualified professionals before making decisions. Now, let's frame the common $500,000 dilemma. For households earning around $200,000 annually, a $500,000 purchase aligns with the 2.5 times income rule. However, affordability is not just about matching a ratio to income. It hinges on liquidity and maintaining robust cash reserves to absorb surprises. To set expectations, we begin with common benchmarks. The purchase price is often anchored to around 2.5 times gross income, which is why $200,000 of income commonly leads buyers to target $500,000. Lenders will not only look at income, but also total debt to income, which includes obligations such as student loans, regardless of whether forgiveness is pending. Next, cash-based rules emphasize maintaining liquidity. Aiming for 20% down helps avoid private mortgage insurance, and you should allocate an additional 3 to 5% for closing costs. Finally, consider your monthly budget. Aim to keep principal, interest, taxes, and insurance under 30% of your net income. Pushing toward 40 to 50% demands trade-offs, often reducing savings capacity and lifestyle flexibility. Next, let's focus on the most important guardrail, your emergency fund. Keep 6 to 9 months of living expenses in a separate account, distinct from the money allocated for the down payment and closing costs. Homeownership brings inevitable surprises, from maintenance to insurance deductibles. If your closing would deplete most liquid savings, it is prudent to pause and rebuild the safety cushion. This liquidity buffer reduces stress and protects you from income disruptions or market volatility. To integrate these rules, follow a clear decision flow. First, check whether the target price is around 2.5 times gross income. If not, reassess to lower the price or increase income. If yes, verify cash on hand for 20% down, plus 3 to 5% closing costs. If that cash is not available, either pause to build savings or examine a smaller down payment with PMI, as long as your emergency fund remains untouched. Next, confirm that principal, interest, taxes, and insurance are at or below 30% of net income. If all green lights align, proceed with confidence. If not, consider waiting or lowering your target. Here are illustrative numbers to ground the concepts. We assume a household with $200,000 of gross income and an estimated net take-home of about $11,500 per month. The first scenario shows a $500,000 purchase with 20% down and no PMI, requiring roughly $120,000 to close and yielding an estimated monthly payment around $3,100, or about 27% of net income. The second scenario uses 10% down with PMI, which reduces cash to close to about $70,000, but increases the estimated monthly payment to around $3,630, roughly 32%. The third scenario stretches to $600,000 at 20% down, requiring about $144,000 to close, and producing a monthly payment near $3,750, about 33%. These are approximations and will vary with interest rates, property taxes, insurance, HOA fees, and local costs. Comparing 20% down to 10% down with PMI reveals trade-offs. With 20% down, the monthly payment is lower, and you avoid PMI, which accelerates equity building. However, you need considerably more cash at closing. Conversely, 10% down reduces upfront cash, potentially letting you enter the market sooner. The trade-off is a higher monthly payment due to PMI, at least temporarily. If the property appreciates, or your equity grows through payments, you may later refinance to eliminate PMI, but that outcome depends on market conditions and qualification at that time. Now let's make this actionable. First, estimate your net monthly income after taxes and retirement contributions. Second, set a PITI cap at or below 30% of that net income. Third, use a mortgage calculator to determine a price that meets the PITI target once taxes and insurance are included. Fourth, verify you have cash for the targeted down payment and closing costs while preserving a 6 to 9 month emergency fund. Fifth, model a 10% down option with PMI to see if early entry is worthwhile relative to the higher monthly cost. Sixth, stress test by increasing the interest rate assumption and property taxes to ensure your budget remains stable. Finally, proceed only if these checks are satisfied. Quiz time. What is the recommended size of your emergency fund when buying a home? Option A, 1 to 3 months of living expenses. Option B, 6 to 9 months of living expenses, kept separate from the down payment. Option C, only enough to cover closing costs. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 6 to 9 months of living expenses, kept separate from your down payment funds. This buffer helps you handle unexpected costs or income interruptions without resorting to high-interest debt or distressed sales. Let's translate the 30% rule into a workable budget. Keeping principal, interest, taxes, and insurance under 30% of net income supports ongoing savings and flexibility. In high-cost markets, buyers sometimes allocate 40 to 50%, but that tends to crowd out retirement contributions, childcare, and lifestyle spending. Before you stretch, weigh the future goals you do not want to sacrifice. The pie chart shows a sample allocation with 30% to housing, 20% to savings and retirement, 35% to essentials, and 15% to lifestyle. Second quiz. Which obligation do lenders typically include in your debt-to-income calculation even if forgiveness is pending? Option A is student loans. Option B is the color of your car. Option C is streaming subscriptions. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is student loans. Lenders typically include student loan obligations in the debt-to-income calculation, even if forgiveness is pending. Next, we consider controversial strategies for entering the market. Using 10% down with PMI can reduce cash to close and enable earlier entry if you expect home prices to rise. If appreciation or interest rate declines occur, you may refinance to remove PMI when your equity exceeds 20%. Additionally, focus on the least expensive property in a quality neighborhood to benefit from more consistent appreciation. Still, remain conservative. Never compromise your emergency fund just to avoid PMI. Here is a typical timeline for entering with 10% down and refinancing later. First, close with 10% down and PMI while preserving your emergency fund. Next, stabilize your finances with consistent, on-time payments. Then, as equity builds through appreciation and principal reduction, monitor when your loan-to-value reaches 80%. Finally, consider refinancing to remove PMI and optimize the interest rate, but only if the savings justify the transaction costs and if you still qualify. To recap the most important ideas, safety comes from liquidity, not just income. Aim for 20% down plus 3 to 5% closing, while preserving 6 to 9 months of living expenses. Keep PITI at or below 30% of net income to maintain flexibility. If you consider 10% down with PMI, treat it as a bridge and only proceed if your safety net remains robust. Finally, selecting the least expensive property in a desirable neighborhood may provide steadier appreciation. In summary, use the 2.5 times income guideline as a starting point rather than a final answer. Protect your emergency fund above all else. Understand your cash to close and your monthly payment ceiling before you shop. When timing matters, a 10% down strategy with PMI may help you enter the market, provided you maintain discipline and preserve liquidity. Stress test your plan and proceed only when the key checks align. Thanks for watching. If this video helped you clarify how much house you can truly afford, please like the video, share it with a friend who is house hunting, and subscribe for more practical breakdowns. Finally, tell us in the comments, what's your target price and which trade-offs are you considering? Your insights could help another viewer.